Hi, everyone. Today I'm joined by Wes Mathews, Senior Manager Director and Head of Investment Strategies at NEOS Investments. Wes has extensive experience in portfolio construction, option-based strategies, and ETF development. Wes, thank you for taking the time to join me today. Before we get into NEOS and the high-income investing and the products that NEOS has, tell me about your career journey and what led you to NEOS, and maybe a little bit about your family.
Sure. Yeah. Thanks, Sean. Thanks for having me on the channel. I appreciate the chance to be here. And yeah, so a little bit about myself. I've been in the industry, honestly, a little bit off and on, going way back to about 2000, 2002. Traded on my own in my own personal account, even back in high school days where I was doing covered calls and some spreads and things like that. I was a prop trader for a while. I worked at a couple different trading shops. I did product development, like you mentioned as well. And so most of my career has been in finance, as you mentioned, structuring, building funds. Before I came to NEOS, I was actually at Milliman, where we were the sub-advisors helping build the innovator buffered ETFs. So I've spent quite a bit of time building options-based ETFs. And it was just a natural fit to join up with Troy and Garrett here. Excited about what they've been building in the past. They were some of the creators of the original covered call funds back in the day, doing QYLD, XYLD, things like that. And so we had a lot of overlap. We spoke at conferences together, panels together, and it was just a great way to merge with some folks that had a similar philosophy of how to do things.
Awesome. Tell me a little bit about your family, if you don't mind.
Yeah. I've been married for 20 plus years now. I got a couple daughters who are getting older, in college age at this point almost.
Yeah.
One's in college, one's almost there. So yeah, I live in the Chicagoland area and really enjoying life right now.
Wes, what attracted you to NEOS, and what do you believe the company is doing differently from other options-based and high-income ETF providers?
Yeah, part of it, as I mentioned, it was just similarity of how we build products. You know, my background, as I mentioned, building a lot of the buffered funds. Troy and Garrett focus more on the income side of things while using the same building blocks. So at the end of the day, we're using a lot of listed or flex traded options on indices, single names, and it's all the same pieces. It's just how you put them together. You can create essentially infinite number of payoffs using options in the space: leverage, caps, income, floors, buffers. I mean, you can put these things together in an infinite number of configurations. And so that's what's exciting about options use inside of ETFs. It's a fairly newer thing, relatively speaking, compared to going back to index funds and regular mutual funds. But, Troy and Garrett, for me, and the rest of the NEOS team that has significant experience, we try to do things very thoughtfully. I think was one of the main things that drew me here is there's a lot of time and effort put into what do we bring to market and how do we bring it to market. We want to make sure we build products that are sustainable and that we think are going to be around for 20, 30, 50 years. We don't tend to throw, dozens of things on the wall and see what sticks. Our product development cycle is pretty thorough in terms of how we bring to market. So a lot of that was just similar philosophy and how I've operated and how they operate historically.
One of the questions that came up from my community this week is NEOS looking at maybe a consumer staples fund, right? Right now, we're seeing in the market a lot of rotation out of tech. You'll see that go into consumer staples, on the rotation back into the tech. Those things are happening almost daily or hourly, even at some points. Is NEOS to offer a consumer staples product, or is that something you guys may be looking at in the future?
We have not yet. I mean, at this point, we have 19 different funds. And as you've probably noticed, we've tried to build that out amongst a lot of different areas of a portfolio. So it's not just the normal equity covered calls like S&P and NASDAQ, but we're looking at asset classes that don't typically generate income, like gold. We have real estate MLP funds. We have Bitcoin. So we're kind of trying to expand that as much as we reasonably can. And create income opportunities for folks in different parts of the portfolio. So you don't have to just allocate equity for income. You can do it in the fixed income sleeve. You can do it in hard assets sleeve. You can do it in, currency sleeve. And so that being said, to your question directly, no, we don't have anything in the consumer staples side at this point. We've looked at that a little bit. It's tough because you always have to balance what's the volatility of an asset class you're looking to invest into. What kind of harvest or ball can you harvest on that? And is that attractive enough of an offering for folks?
Makes perfect sense.
Yep.
Good segue. Kind of, we were talking about Paycheck, the portfolio, and how I live. I invest in the three buckets: long-term growth stocks for equity, closed-end funds for additional equity, and then high yield funds to service my margin interest costs and to erode away my living expenses. How do funds like SPYI, QQQI, IWMI, and the others, I know you mentioned gold, which is IAUI, how do those funds play into a portfolio if somebody's trying to live out of their account like that?
Yeah, so I would say in general, our goal is to deliver funds that predictably pay distributions monthly. And so if you look at our lineup, you'll see that each of those funds that you mentioned, as well as the other ones, each have a unique distribution target range. For S&P, that's 10 to 12. For the NASDAQ, that's 13 to 15. For Bitcoin, it's up in the 25 to 30 range. So it varies pretty wildly based on the exposure. But we're trying to match that with the natural volatility of the underlying asset class. So we don't want to overpromise and then have to overcover and hurt your upside participation potential. And so we try to pick distribution targets that are, somewhat aggressive in the sense of we want to try to maximize predictable distributions while still making sure we can deliver, in perpetuity, ideally. And so for us, we see people utilize these across the portfolio. I can't really tell one person versus another how they should use one or another, but we are trying to build pieces such that, let's say you have a bent towards gold. You really like gold. You think it's going to be stable or growing for a while here, or you want the income coming off of it. It's a way to generate stable, predictable incomes through different market cycles. I will say, there's kind of old school strategies that are more, we do the same thing every month. We sell away all of your upside. And that's not always the best solution. I'll give you a quick example. Like if the markets are falling dramatically and volatility is through the roof, let's say we go back to like an '08 type environment or '09. I might be collecting a ton of premium by selling calls, but if I sell away all my upside, I've given away any ability to rally with the market.
Right.
And so that's what we try to do, is be more dynamic. We try to make sure that every month we're looking at volatility levels, premium levels, figuring out how much do we need to cover to make the delivery of the stated desired yield while still leaving some of the market exposure uncovered.
Wes, thank you for that answer. Can you walk us through exactly how NEOS generates its monthly distribution, including the role of underlying dividends, options, premiums, and realized gains? How does the team determine an appropriate distribution level each month?
Yeah, so I'll take SPYI as an example here. So if we look back, like I mentioned, we pick distribution targets for each product that are reflective of the natural volatility of the underlying. And so the team here will look back and we'll say, what's the natural volatility for the S&P historically? And as I think about selling away some of my upside by writing calls, I want to ideally never have to cover 100% of my upside. And I also like to write those calls out of the money if possible. And so if you think about that, a worst case scenario for a PM would be an ultra low vol environment. If volatility drops to low mid single digits for the S&P, for instance, the premiums are going to come way, way down in terms of what I can get for selling a call. In that scenario, I might have to cover close to or at 100% at the money. And so that's how we're picking the distribution targets we do. We don't want that to be the case. We can't guarantee that, but it'd be pretty unlikely for the S&P to have to get so low we'd have to cover 100% at the money. So that's really kind of the rationale there. We really have those two levers to pull each month. How far out of the money do we sell our calls, and on what notional coverage do we sell it? So that varies quite a bit month by month. Right now we're anywhere between 50, 60% on most of our key equity products.
How should investors evaluate whether a fund's distribution is sustainable enough to serve the purpose over the long term? What are some key performance indicators you would be looking at to assess an investment, and if it's something that you feel would be a good long-term position?
Yeah, so it's a good question. I think there's a lot to that and how you think about an investment and the return of an investment. And I know you spent a lot of time on this personally with some of the work you've done. Is total return is important. It's important to look at not just price return, but also what's the distribution rates that I'm getting, and those netted together are your total return. And so for us, we're looking to try to give you a total return that's pretty high. It's not always going to keep up with the underlying. In fact, most of the time, covered call strategies don't, because you are trading away some of your upside typically for that premium. I would say, in terms of how to measure if it's performing well or not, one other thing that's important to know is that covered call strategies, unless they have an explicit hedge built in, you should expect downside exposure to be pretty much 1-to-1, except for the distributions that you're getting on a monthly basis. So I think that could be a misconception people say. They might be looking at these like a preferred stock or something like that, where they just expect every month it just kind of sits stable. These are going to move around. You're going to have some upside to the market based on what's not covered. You're also going to have a lot of downside to the market because these are 1-to-1 exposures with the S&P or the NASDAQ or Russell. And so I think just having a proper expectation that you have downside exposure with all covered call strategies. You have some limited upside, but you're also getting income that offsets that trade-off. So I think there's a lot of things to consider when looking at performance and whether it's paying off as you'd expect or not.
One of the things that I find fascinating about NEOS is the emphasis on tax efficiency through Section 1256 with index options, tax loss harvesting, and return of capital distributions. How do these strategies work together, and how can investors distinguish constructive, tax-efficient return of capital from destructive return of capital?
Yeah, so a couple of questions in there. I would say the tax efficiency of our strategies, as well as what I'll consider kind of Gen 2 covered call strategies in the past few years, is really an improvement upon the tax efficiency of what Gen 1 did. If you look back, and there's no slam on Gen 1, so our founders were part of Gen 1 as well. So it's just an evolution in the space in terms of how to do it a little bit different and hopefully better. Gen 1 typically sold away most, if not all, of your upside. Like I said earlier, very, kind of rote, same thing every month. A lot of those were distributing ordinary income tax distributions. What we've tried to do with the newer iterations is, like you mentioned, utilize 1256 contracts when possible. Not every one of our funds has 1256 contracts that we can use, but the major indices do. Those are treated as 60% long-term and 40% short-term gains. And so that's a benefit you get just by using that, a typical option that would be ordinary income. That's one benefit. The bigger one probably is really focusing on loss harvesting and return of capital. Those go hand in hand. And so when I sell a call each month, I'm selling that for NEOS at least 7 weeks out, and then I'm rolling it at the end of the month. And so if the markets have climbed, oftentimes they've gone through my caps where I sold those, my upsides, and upside calls, I should say, and I'm buying those back oftentimes at a loss if the market's up enough. If I buy those back at a loss enough times throughout the year, at the end of the year, those losses are netted together with the distributions I made, and they can be reclassified as return of capital, which is really a return of capital classification from a tax standpoint, as opposed to saying, we're giving you your money back. That would be sort of a return of principal, a little bit different than return of capital in terms of a classification standpoint. So that being said, return of capital is pretty high for the funds, especially in like a stronger bull market. Last year, we were 95% on SPYI and 99% on QQQI. If you hold these funds long enough where you get return of capital, and I didn't touch on this yet, which I should. When you get return of capital, it shows up in your 1099 and your cost basis is adjusted lower accordingly. If you hold this fund or any of these funds long enough that your cost basis gets to zero, any distributions after that are long-term capital gains typically.
We touched on this a little bit, Wes. I'm constantly telling my audience that yield alone is not the complete scorecard. It's the change in the fund's value plus the distributions, or the way I typically word it is paper gains or losses plus dividends equals your total return. And that's really the scoreboard people should be looking at. NEOS does a really good job with QQQI, SPYI, and others of maintaining good NAV stability while also paying a good distribution. What warning signs should an investor look at that NAV erosion is becoming structural? And again, it seems like the NEOS team has that down to a pretty good science.
Yeah, so our goal is for any of our funds to basically sustain or grow NAV over a full market cycle. Like we aren't here to try to give you really high beta and minimal distributions. We're here to try to maximize sustainable distributions over the long term. That being said, there's a few things that can hurt NAV. One is a firm could over distribute. If I look at SPY and I think 10 to 12 is fair, if I start distributing 30 to 50 a year, you're going to see your NAV drop pretty quickly, precipitously, no matter what the underlying is doing. So I think that's where you need to be aware. Sometimes the strategy will over distribute. And even if you're in a bull market, your fund value is going down quickly. Our goal is to give you some upside exposure. So if the markets are healthy, we don't want to be 100% covered. we hope that you have some upside in the NAV as well. That would be one. I think NAV, when I think about NAV erosion, I think a lot of people confuse a NAV decrease with NAV erosion. Like, just a reminder, like I mentioned earlier, these funds are all ours and competitors, anybody in the covered call space are exposed to the underlying. So if you're in an asset class that falls 50, 60% for the year, you should expect the value of that asset class to be down and these covered call funds to be down, except for the distributions you've received over that year. And that's where your total return might look a little bit better because you've gotten many months of payments even while the market's falling.
How should investors expect the NEOS funds, just specifically SPYI, QQQI, and IWMI, to perform during a strong bull market, a sideways market, a sharp correction, and maybe even a prolonged bear market?
Sure.
Are there particular market environments where each strategy is expected to perform best or face the greatest challenge?
Yeah, so each one of those has a lot of nuance to it, but I'll try to give a high level answer to it. So let's start with strong bull. So a strong bull market, we're going to have a percentage of the portfolio that's covered. So whatever portion's covered is you participate up to those strike prices. Usually those are like 1% to 3% out of the money for SPYI, for instance. You'll participate up to that. You keep the premium, but after that, your upside is limited to the portion that's not covered. We buy those positions back at a loss. That allows us to do return of capital loss harvesting. But from a performance standpoint, if you see a really strong bull market, you should expect a covered call strategy to lag behind, simply because you are trading away some of the upside potential for income now. I'm going to add one, moderate growth market where we're just up a little bit every month. That's pretty ideal for a covered call strategy. You're collecting premium to sell away part of your upside, but you're actually getting market growth maybe up to or right around your strike levels. That's pretty ideal because you're being paid a little bit of a premium to do that and getting the growth of the underlying. A flat market's similar. If the market doesn't move anywhere, I'm collecting premium every month in a covered call strategy that goes towards my total return without having a negative impact. And the same is true in a down market. The downside of a down market is you basically have 1-to-1 exposure in the underlying, but you are getting some distributions monthly to help offset that downside loss.
Looking ahead, what should investors expect next from NEOS in terms of new products, strategies, or innovations? And more broadly, where do you think the industry goes from here, maybe in the next 5 years?
Yeah, so we've seen a number of other players in this space kind of jump into the similar idea of let's be more tax efficient with covered call strategies. That's helped us tremendously. That's helped some of our peer group as well to grow. I'd expect to see more of that in the space. For us, as I mentioned, we have 19 funds at this point. We have kind of a handful more planned coming up in the future to help sort of complete that portfolio, fill that out, fill in a couple gaps that we see opportunities in. A key thing for us is building products where we're sure there's liquidity and good market making capabilities in the option space. But I would expect there to be continued development, not just in covered calls, but options-based ETFs in general. We've already seen that with some of the other income style or more exotic type payoffs in the space using options or OTC options recently as well.
Right. Yeah, and a couple of your newer funds are the boosted funds on the NASDAQ and the S&P 500. Can you talk about those a little bit?
Yeah, so the boosted was really in response to investor feedback saying, hey, we love your core strategies. We see that you have a hedge protected version. Can you give us one that has a little bit more upside potential or more income potential? And so the boosted is essentially a 50% additional exposure to those asset classes, as well as the 50% higher distribution rate. And so it's really just kind of dialing up the exposure by a moderate amount, but meaningful for folks who are looking for more exposure.
Any other questions you think would be good for my audience?
I'm often asked, what are the risks? And I think the biggest risk is just education, which is just great that channels like this exist and platforms like yours exist to help educate people. I want people to understand what they're getting when they buy our funds. We don't want anybody to be really surprised. And so I think a lot of it is just understanding there's an opportunity cost trade-off with anything that uses options, whether that's for protection or income like this or levered funds that use options. Like there's a trade-off and you need to just understand where that is. For us, that trade-off is you give away some of the upside for income now.
What's your opinion on dollar cost averaging versus investment in the market? I always, what you're talking about essentially is the trade-off of these funds and the structure of these funds.
Yeah.
in my community, I'm always talking about dollar cost averaging. So you're buying at the highs, buying at the lows, buying at the averages over time.
Sure.
And it kind of smooths out that volatility. We're seeing that with Bitcoin, right? If you bought Bitcoin at 110 and now we're at 63,000, you lost money, right?
Sure.
So how important do you think it is in a market that's very volatile, which is how
Yep.
covered call funds make their premiums,
Yep.
to dollar cost average in an environment like that for the long term?
Yeah, I think I mean, it comes down to the individual and their situation they're in and what they're looking to accomplish. I resonate with that because I own BTCI and I've been reinvesting my dividends pretty regularly. I'm not currently living off my distributions. I do reinvest them, and that does lower my cost basis over time by reinvesting. Um, and so, yeah, there's dollar cost averaging makes a lot of sense for some people if they're looking to build a position. For others who are maybe later in life and in retirement, might be living off it. Maybe they aren't needing to reinvest. They're just going to live off this and see that trail. We see people try to live off funds like ours in a tax efficient manner with a little bit smaller portion of the portfolio as well. Because our distribution rates are a little bit higher than what people are used to in the fixed income side of things, we're seeing
Right.
people be able to live with a similar income level with a lesser allocation and be more invested in the rest of the market still, which is kind of nice as well.
Yeah. Well, Wes, I appreciate you taking the time to meet with me today. I'm sure my community is going to love it. I greatly appreciate your time, and hopefully we can talk again more in the future.
Yeah, thanks, Sean.